Let's talk a little bit about setting up your portfolio. This is one of those things. It's been so long since I did it. Sometimes I forget that this is, difficult, maybe a little bit of an anxiety provoking experience to set up your portfolio the first time. Katie and I did this back in 2004. So it's been a long time, and we're basically using the same portfolio. We've made a couple of minor changes over the years. There's been blog posts that went out when we did. But for the most part, we're following the same plan we have been for the last almost 20 years. So it's wonderful to get this sort of thing set up, to have a written investing policy statement, a written financial plan, if you will. And if you need a lot of help with this, I recommend you check out our Fire Your Financial Advisor course. You can find that under our courses at whitecoatinvestor.com. Whitecoatinvestor.com/FYFA will take you directly there. This is an evergreen course you can take whenever it's convenient to you that will help you to do this process. But the basic process is not that complicated. Okay. What do you do first? You set your goals. Without any goals, investing doesn't make sense, right? Everyone always wants to choose investments first. But unless you know what you're investing for, it's very difficult to choose investments. So that's step one, is to set your goals. Second, you develop an asset allocation. An asset allocation is your mix of investments. How much are you going to have in stocks? How much are you going to have in bonds? How much are you going to have in real estate? Anything else you want to invest in, precious metals or crypto or whatever else. How much are you going to put in that? And then within each of those categories, you may divide it into further sub-asset classes. You might invest within real estate, maybe publicly traded REITs, maybe debt funds, maybe, direct rental properties. Within stocks, maybe how much goes in international, how much goes in small stocks, how much goes in value stocks, etc. And you write this down, the percentages you want, because the idea is that in any given year, one of these asset classes is going to do better than all the other ones, and one of them is going to do the worst. And so at the end of the year, what you do is you rebalance back to the original percentages. And what that forces you to do is to sell high and buy low. You're constantly doing that as you go through your investing career. And that's a formula for success. It doesn't require you to know the future. You have the same risk each year as far as your mix of investments go. And so you basically set it, you pick the investments, and you rebalance as you go. Okay, so then the tricky part for a lot of people, although I think this is actually the easiest part, once you have that asset allocation, is to implement it, right? And all this means for me, for example, our asset allocation has a 25% allocation to the overall U.S. stock market. That's a quarter of our retirement money, quarter of our portfolio goes into U.S. stocks, essentially. And what do we use for that? Well, it's really pretty easy. We use the Vanguard Total Stock Market Fund. And so 25% of our money goes right into that fund and essentially buys the 5,000 stocks that are publicly traded in the United States. But it's super easy because we just have one fund that meets that entire asset allocation. Now, in other asset classes, you may find that you can't do that. For example, if you have 25% of your portfolio in real estate, you might not want all 25% in one property. Even if it's the property down the street and you can watch it really closely, you may want a little more diversification than that. So in some asset classes, you got to have more than one holding. But for many of them, especially when it's easy to get a very diversified holding like an index fund, we just have one holding for it. For example, we dedicate 15% of our portfolio to small value stocks. And what do we use for that? We use the Vanguard Small Value Index Fund. One holding, very simple. But in other asset classes, we can't keep it that simple. For example, we have 10% of our portfolio in nominal bonds, regular old bonds. And for a long time, I had all of those in the TSP. This is the Thrift Savings Plan. It's a 401k for federal employees. And it all went into the G fund there. Well, eventually I filled my entire TSP with the G fund, and I still need more money in bonds. So I had to do something else. And so mostly what we do is a muni bond fund at Vanguard in our taxable account, in addition to that G fund. That's how we get our nominal bond allocation. So sometimes the implementation can be a little bit complicated. Other times it's very, very, very simple. And it's really the easiest part of the whole process. So you've set your goals, you've decided on an asset allocation, and you have implemented that asset allocation. The final step is just to maintain the plan. meaning you direct new investments into the plan. You no longer have to ask yourself, hey, I got $100,000. What should I do with it? It just goes in the plan like everything else. Just like the $5,000 you invest this month from your regular monthly earnings, it just goes into the plan. You rebalance once a year or once every couple of years or whatever your plan says you should do. And so it's not that complicated to sort out. So one of the difficult things for people is figuring out, okay, well, what should my mix of investments be? How much should I put in stocks? And I could give you percentages. I could say you need to put this much in here and this much in here and this much in here. And lots of investment gurus out there do that. But the truth is that they don't know. I don't know what's going to do best going forward. I don't know what the optimal mix of investments is. My goal is to pick something reasonable, something that will do well no matter what future markets bring. So you probably ought to have some money in stocks. You probably ought to have some money in bonds. You might want some money in real estate. Most people have at least some money in real estate. The majority of your money probably ought to be into relatively risky assets. And I'm not talking about, shorting Bitcoin. I'm talking about stocks and real estate, risky assets, not CDs, not bonds, et cetera. Okay. And a minority for most of us during our earning careers in bonds or other less risky assets. So that's kind of the general philosophy behind doing this. If you want more information, you can also look at a blog post I have called How to Build an Investment Portfolio, and it'll take you through that step by step as well. But the bottom line is you are looking to put together a number of asset classes into a portfolio, somewhere between 3 and 10. Beyond 10, you're just playing with your money. Less than 3, you probably aren't as diversified as you should be. And then you rebalance it once a year. So I can't give you specific percentage instructions because the truth is, I don't know. I don't know what's going to do the best. If I knew that, I'd just tell you to put all your money in that. But pick something reasonable, diversify between asset classes, diversify within the asset classes, and then stick with your plan. That's the hardest part, right? Because you realize how easy it is to change your plan. But what happens when we change it? We're almost always performance chasing. That almost always results in lower returns. So I hope that's helpful to you. If you need more help with that, I recommend that Fire Your Financial Advisor course, whitecodeinvestor.com/FYFA.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.